Hey, managerial accounting students, it's Professor Adams. I hope you're comfortable with the content from the prologue and chapter 1. And now we are ready to dive into chapter 2, job order costing. So we're going to cover job order costing over the next two chapters, chapters 2 and 3. So chapter 2 is kind of an intro to the concepts, and then in chapter 3 we're going to work on all the journal entries and T accounts that would go with that. So here's the big idea, the overview. We're going to use job order costing when we're making many different products. Probably those products have something unique and different about them. And when we say products, that could also be a service. And the second point here, products are manufactured to order. So we're not making tons and tons of the same thing. We're making something a little bit different each time, something that can be made to order, or like I said, it could even be a service. And number 3, the unique nature of each order requires tracing or allocating costs to each of those jobs. So each job, each product has something a little bit different about it, or at least it's customizable in some way, and we track our costs then by job, and that's what we call a job order costing system. So some examples, they say Boeing, if we're making aircraft, they don't just make cookie cutter airplanes off of the assembly line, they're made to order. So when a customer orders airplanes from Boeing, it's a very specific order for a specific quantity, and they make them exactly to the specifications that they've agreed upon. They're not all identical. The other two examples, they mentioned large-scale construction. Really any type of construction, whether it's large or small, is kind of irrelevant. If we're building commercial buildings or houses, it doesn't really matter. Each of those jobs is somewhat unique. We don't assume that they're all identical. And then movie production, whether it's Disney or any other studio, when you make a movie, each movie production process is unique. There's no, well, there might be some similarities, but the cost of making an animated film is a lot different than the cost of making Star Wars versus making Monty Python and the Holy Grail, right? Clearly totally different production budgets. So we're going to track costs by job. We don't assume that they're all the same. They're all somewhat unique in nature. So the basic cost flow that we're looking at, we've got direct materials and direct labor. Remember those? Those are our direct costs, and those are going to be applied directly to the job. So we're going to charge direct material and direct labor to each job as that work is performed. So as we requisition materials into each job, as we work hours on each job, we have to track those hours worked on each job. And then we have our indirect costs, MO, right? Everything that's indirect is going to be dumped into the MO bucket. And we're going to accumulate all of the MO, all of those indirect materials, indirect labor, and all of those other indirect costs. Do you remember what type of stuff goes into MO? It could be rent, utilities, insurance, depreciation, property taxes, all related to our manufacturing facility, and a lot of other things. Those are just examples. So all of that's going to be accumulated in the MO bucket, and then we're going to allocate MO. We're going to apply MO based on an allocation basis to those jobs. We can't trace MO directly to the jobs. There's a reason that it's called indirect costs. It's not easily and conveniently traceable. So we're going to put it all together in the MO bucket, and then we're going to come up with one method of allocating the MO over to those jobs. So this is an example of a job cost sheet, and whether it's on paper or it's in a computer, here's an example of the type of information we'd be tracking. We'd probably have some type of job number, a date, department, all of that. So what are we making? We're making a wooden cargo crate, and we're going to see what it looks like to track the costs for this job. So first we have our direct materials. So Perco has a materials requisition form, and they're requisitioning probably some amount of wood or lumber to build this crate. So they've specified exactly what they're using on this job. They've put the unit cost and the total cost, so $116 of materials. So we put the $116 here on the job cost sheet for direct materials. So we've specified that. We've tied it to our materials requisition. So we're tying out our documents. And again, whether they're paper or in a computerized system, we want to tie our documents together to create supporting evidence for what we're doing. Next, we're going to deal with our direct labor. So anybody working on this job has to track their time by job. So they've clocked in, clocked out. We've got 8 hours of work at $15 an hour. So $120 of labor. And again, we go back here, we plug in our direct labor hours and costs. So $120 of labor. But now mow, that becomes the mystery, right? The direct costs are easy. They're conveniently and easily traceable to that job. But then we got to figure out what to do with the mow. So let's go to predetermined overhead rate. So we need to talk a bit about that and figure out how that works with mow here. First, let's talk about allocation bases. An allocation base, like direct labor hours, labor dollars, machine hours, is what we're going to use to assign mow to each of our jobs. So we're going to have some type of allocation base. Why do we use an allocation base? Well, first, because we can't directly trace these mow costs to the jobs, right? That's why they're indirect. That's why they're in mow to start with. So A says it's impossible or difficult to trace overhead costs to particular jobs. So we can't trace it. We're going to have to figure out a way to allocate it. B, mow consists of many different items ranging from grease used in machines to the production manager's salary. Again, all indirect costs, virtually impossible to trace directly to each job, so we're going to need to allocate. And C, many types of manufacturing overhead costs are fixed, even though output fluctuates during the period. Now that's an interesting point, and we're going to explore that more. What happens when our level of activity, our output, goes up or down? What does that do to the amount of mow that we're going to allocate to each job? So we'll address that later. I'm just planting a seed for you to think about. What if we only have one job during the year? What if business is really slow this year? What will that do to the amount of mow that we end up allocating to each job? Hopefully a little bit later we'll be able to answer that question once we understand more about how we use allocation bases and the predetermined overhead rate. Let's keep going and we will revisit that question. So we're gonna allocate mow based on the predetermined overhead rate, which we call POHR, P-O-H-R. I know we needed more letters and acronyms in accounting, right? Well, there's another one. We're going to allocate mow using the POHR. Sounds like we're speaking a foreign language, right? No, we're just speaking accounting. So we're going to allocate the mow using the POHR. We're going to use that POHR to apply overhead to jobs. But that predetermined overhead rate is going to be computed before the period begins. So we're going to be basing that on estimates. Now, if you remember when we talked about the difference between managerial accounting and financial accounting, managerial accounting is focused on timeliness and relevance. So it's okay that we're using estimates. We can't wait until after the fact for financial accounting accuracy. We're going to base this on estimates, and that's okay. We have to be okay with that. So predetermined overhead rate is computed by taking your estimated total mow for the coming period. So we're estimating mow for the upcoming period, and we're going to divide it by the estimated total units in the allocation base or the cost driver. So that allocation base should be the cost driver, meaning what is causing cost to happen? Is it making more units? Is it working more hours? Is it more labor dollars? Is it machine hours? So in the real world, that would be a tough decision to make. In textbook land, they're going to tell you what to use as your allocation base. But just think about this. If we're taking an estimate and dividing it by an estimate, How often do you think we're going to be exactly right? An estimate divided by an estimate, and that's what we're going to use to allocate MO to the jobs. How often do you think we're going to be spot on? If you said maybe never, that's probably a good guess, right? So there is a process at the end where we're going to true up those differences. So don't worry, we're going to work it all out. We don't just estimate and walk away, but we need to have something to use as an estimate during the period. Why? Why do we need to estimate? Why can't we do this after the fact with accuracy? Predetermined overhead rates that rely upon estimated data are often used because, well, number one, we can't wait. Number one, actual overhead for the period is not known until the end of the period. Thus, that prevents us from estimating our job costs during the period. Well, who cares? Well, that's kind of important in terms of choosing how to price your jobs, how to bid your jobs to customers. How do you determine how much you're going to charge a customer for a particular job? Are you just guessing? Well, hopefully it's more of an educated guess using the predetermined overhead rate, which it's still based on an estimate, but it's definitely an educated estimate based on past data, based on our business knowledge. So it's not just a random guess. So the answer is we can't wait until the end. We need to have a predetermined overhead rate in order to accurately, well, somewhat accurately estimate our job costs during the period. And number two, actual overhead costs can fluctuate seasonally, thus misleading decision makers. So what they're implying is that if our volume, our activity level is fluctuating throughout the year, we don't want to have these changes, these fluctuations in our overhead rate. We want to just compute it once at the beginning of the year, or if our company decides we want to do it at the beginning of the quarter, that's fine, but we want to do it once ahead of time and not change it every day or every week. We want to look at the big picture and come up with a reasonable predetermined overhead rate. So we don't want to do it day by day or seasonally because it might lead to poor decisions, misleading data. So when we compute the predetermined overhead rate, first let me say I think this slide massively overcomplicates this. This doesn't need to be this complicated. We previously talked about y equals a plus bx when we're dealing with mixed cost, meaning a cost that includes both fixed and variable components, which mode definitely is going to include both fixed and variable components. So what they're telling us here is that the predetermined overhead rate is going to be computed before the period begins. We know that. And they're suggesting this 4-step process, which I think might make it a little more complicated than it needs to be. But it would start by estimating the total amount of allocation base. So that's going to be our denominator, the bottom of the fraction. So we're going to estimate the total allocation base that will be required for next period's estimated level of production. Step 2, we're going to estimate the total fixed MO for the coming period and the variable MO as a cost per unit of the allocation base. And we're going to use the following equation, y equals a plus bx, to estimate the total amount of manufacturing overhead. So all they're saying is that we're going to add together the fixed plus the variable times the level of activity and get the total estimated MO for the period. So really all of that, steps 1, 2, and 3, what they just said is that we're going to add up the fixed and the variable costs to get the total estimated MO for the period. And then we're going to use that to compute the predetermined overhead rate, dividing the estimated MO divided by the estimated allocation base. So let's take a look at it. We're going to go back to Pearco. Pearco estimates that it will require 160,000 direct labor hours to meet the coming period's estimated production level. Okay, so they're basing it on direct labor hours. They believe that is their cost driver, that's their allocation base, and so they've estimated that, and that goes in the denominator. In addition, the company estimates total fixed mow at 200,000. So that's A. Okay, so that's our A in y equals A plus BX. And variable mow at a cost of $2.75 per direct labor hour. So we're going to take $2.75 and multiply it by 160,000 direct labor hours. So that's BX. B is 2.75 and X is 160,000. So we multiply those together, we get 440,000. So we add together fixed of 200,000 plus BX, the variable component, which is 440,000, and we get a total estimated mow of Y equals 640,000. So that ends up being our numerator. So we've got 640,000 in the numerator divided by 160,000 in the denominator, and we have a predetermined overhead rate then of $4 per direct labor hour. 640 divided by 160 gives us $4 per DLH, direct labor hour. So now that we have a predetermined overhead rate, now we can apply overhead to each of our jobs. So we go back to good old job A143 where we were making that wooden cargo crate. So we apply the mow based on the labor hours. So it's 8 hours times predetermined overhead rate of $4 per hour. And we get $32 of mow gets applied to this job. So now we're going to take a look at the total cost and the unit product cost of that job using that plant-wide predetermined overhead rate. So really all we're saying is we're going to add it all up. So we're adding the direct materials, the direct labor, and the mow, and we get a total cost of $268. So that's our total cost. And then that was for 2 units. If you read the job sheet carefully, it was for 2 units. So we could say that our unit product cost is $134. Let's do a quick check. Job WR53 at NW Fab Inc. required $200 of direct materials and 10 direct labor hours at $15 per hour. Estimated total overhead for the year was $760,000 and estimated direct labor hours were $20,000. What would be recorded as the cost of job WR53? So when they say the total cost of the job, that includes direct materials plus direct labor plus mow. So the trickiest part is that you need to compute the predetermined overhead rate and apply it to this job. So you have to figure out how much mow would be applied to this job. Go ahead and hit the pause button for a moment while you work this out. All right, did you get the answer? So first we're going to take direct materials of 200. All right, 200, sorry, this is super sloppy. Then we're going to add in our labor. How much did you get for labor? $15 an hour times 10 hours. So our direct labor should be $150. And then we still have to figure out mow, right? So then we'll add that in and that will be our total. So what are we going to do about mow? We need to compute the predetermined overhead rate. So how will we do that? Well, they told us that they estimate the total overhead for the year will be $760,000, and they estimate that DLHs will be $20,000. So I'll write up here. We're going to take 760,000 divided by 20,000, and we get our predetermined overhead rate equals, what did you get? Hopefully $38 per direct labor hour. So we're going to take $38 per direct labor hour. There was 10 of them. So we're going to add in mow of $380. And what does that all add up to? Hopefully you got answer D, $730 should be our job cost. Here they show the answer a little bit neater than my scribbling. Were you able to work this out? If not, give it another try. We're going to keep going. So when it comes to predetermined overhead rate and applying MO, allocating MO, if we're inaccurately assigning manufacturing costs to jobs, it can adversely influence our planning and decisions that we have to make as managers in the business. We want to do this with as much accuracy as possible, so that can be a little bit tricky. So job order costing systems can accurately trace direct materials and direct labor, which is great, but job order costing systems often fail to accurately allocate the manufacturing overhead used during the production process to the respective jobs. So this is problematic. We're learning how to do it. We're doing it the best we can, but it is kind of problematic if there's inaccuracies in our manufacturing overhead. Because remember, we're doing this because we want to have an ability to estimate our job costs during the year. We might use that to bid on jobs and figure out pricing for customers. And if it's highly inaccurate, it might lead us to some bad decisions. So we need to be careful about that. So when we choose our allocation base, in a job order costing system, we're often going to be using an allocation base, but sometimes it may not reflect how jobs actually use those overhead resources. The allocation base in predetermined overhead rate needs to be the driver, meaning the cost driver. So it must drive the overhead cost to improve job accuracy. If we just pick any allocation base, it may not be what's causing overhead costs to happen. We want there to be a close correlation between an increase in our cost driver, maybe it's direct labor hours or machine hours, and the increase in our overhead costs. We want those things to be tightly correlated, but that's often really difficult to achieve. Many companies use what we call a single predetermined plant-wide overhead rate to allocate all MO to jobs based on their usage of direct labor hours. So that's what we just did for Pearco and again in the quick check. And that's somewhat common. It's probably the easiest version to do in terms of applying MO. Problems. Number one, it's often overly simplistic and incorrect to assume that direct labor hours is a company's only cost driver when it comes to MO. Number two, if more than one overhead cost driver can be identified, job cost accuracy is improved by using multiple predetermined overhead rates. So let's take a look at how that would work. We're going to compute total cost and unit product cost of a job using multiple predetermined overhead rates. So here we're looking at Dixon Company. Dixon Company has two production departments, milling and assembly. The company uses a job order costing system and computes a predetermined overhead rate in each production department. The predetermined overhead rate in the milling department is based on machine hours. So milling is based on machine. I'm going to underline that. Milling and machine. And the assembly department is going to be based on labor. Okay. So assembly department is based on direct labor. The company uses cost plus pricing and a markup percentage of 75% of total manufacturing costs. So they're using this information to essentially price this job for their customer. So they're going to add up their manufacturing costs and mark it up by 75%. So we'll take a look at how to do that. At the beginning of the year, the company made the following estimates. Okay, so we've got all this data. We've got machine hours for milling and assembly, direct labor hours for milling and assembly. We have our total fixed MO, and then we have our variable manufacturing overhead per machine hour, variable MO per direct labor hour. So what we want to do is figure out our predetermined overhead rates by department. So let's see how to do that. During the current month, the company started and completed job 407. It wants to use its predetermined departmental overhead cost and rate for the milling and assembly departments. So to compute milling, we're going to take the fixed MO for the milling department of $3.90, and then we're going to add the variable MO for the milling department, which was based on machine hours, so $2 per machine hour plus times 60,000 machine hours. Let's go back and see where they're getting that info. They kind of just did it all for you. Let's take a look. So for the milling department, we're going to take this $3.90 right here. So $3.90 plus we're taking 60,000 machine hours times $2. 60,000 times 2. Okay, so if we do all that math, 60 times 2, that'd be 120. This comes out to 510,000. So we add all that up, we've got 510,000 for the milling. Okay, so going back over here, that's where they got 510,000. Okay, so then let me walk you back. I'll show you how to do assembly. Sit tight. So for assembly, we're going to take the 500,000 of fixed. So that's our fixed MO for the assembly department, plus this one's based on, remember, labor hours. So we're going to take 80,000 direct labor hours right here and multiply it by 375. So plus 80,000 times 3.75. Sorry, kind of sloppy, really sloppy. If we do all our math there, that ends up being 800,000. Okay, so that's where they're getting the numbers here, okay? So it came from that chart that they gave us. We just need to know which numbers to use. So that's why I underlined milling in blue and assembly in green, so we could keep track of which one was using which allocation base. So then we're going to take 510,000 and divide it by machine hours. And then we're going to take the 800,000 and divide it by our direct labor hours to get our departmental overhead rates. So there was 60,000 machine hours in the milling department. There was 80,000 direct labor hours in the assembly department. So we divide, and now we've got these predetermined overhead rates for each department. So we're going to use those to apply costs to job 407. So we're going to use that predetermined overhead rate that we just computed, and we've tracked data for job 407. There's machine hours for milling and assembly, direct labor hours for milling and assembly. Take note of those. So notice the milling department chose machine hours as their allocation base. And look, they use a lot of machine hours, so they must believe that's what's driving their costs. But the assembly department opted to use direct labor hours, so it looks like that's a little more labor intensive. So they chose that to be their cost driver because they believe that is what's causing manufacturing overhead to be incurred. And then we've got our direct materials and direct labor by department. So in the milling department, to figure out the amount of MO to apply, we're going to take those 90 machine hours times $8.50 per machine hour that we just computed on the previous slide. So we're going to apply MO of $7.65 to the milling department. For the assembly department, remember it's based on direct labor hours, so we'll take 20 direct labor hours times $10, that was our predetermined overhead rate from the previous slide. So we're going to apply $200 of MO to the assembly department. So when we put it all together, it should look like this. We take our direct materials, direct labor, and then we add in the manufacturing overhead that we just computed. We're going to apply that to each department, and then we add it up in total to get our total job cost of $24.85. Okay, so now we've arrived at our total job cost. Remember, they said they were going to mark it up by 75% to get the price. So this is what they use to price jobs to their customers. So when they say a markup of 75%, that means that we're going to take $2,485 times 75%. So that's $18.63.75, and we add that on top of our job costs. So we would price the job at $4,348.75. Another way to achieve that would be just to take $2,485 times 1.75. 1 being 100% of $2,485, and then 75.75 would be the 75% markup on top of that. So it's important to see here that using the departmental approach to overhead application is going to result in a different selling price for job 407 than we would have come up with using a plant-wide overhead rate. So if we based our overhead rate, if we just did it once for the whole company and we had a plant-wide overhead rate based on, say, machine hours, we very well could have been inaccurately applying our MO and then multiplying that inaccuracy by an extra 75%, which could result in really a bad job on the pricing to our customer. We might underbid the job and not make much money on it, or even lose money on it, or we might overbid the job and the customer might decide to go with somebody else because we're too expensive. So while it's easier to use a plant-wide overhead rate sometimes, trying to come up with the most accurate overhead rate sometimes requires using the departmental approach, which is hopefully going to result in more accuracy in our accounting, but also accuracy in terms of pricing jobs to customers so that we can make good decisions in terms of how much should we bid for a job, and make sure that we're attracting clients that are going to pay us for our services. If we bid too high, we might lose all of our customers. When a company creates overhead rates based on the activities it performs, it's employing an approach that's called activity-based costing. And activity-based costing, or ABC for short, is an alternative approach to developing multiple predetermined overhead rates. Sometimes managers will use ABC, activity-based costing, to more accurately measure the demands that jobs, products, customers, and even other cost objects make on overhead resources. We're going to study ABC, activity-based costing, in a later chapter, so I'll save more thoughts on that topic for a different time. But the point here is that when we break things down further and we really consider what is causing cost to happen, hopefully we come up with more accuracy rather than assuming that direct labor hours is what causes all costs to happen in our company. That would be quite phenomenal if that was true. So big assumptions often lead to inaccuracies. So while that might be convenient for math purposes, it might lead us to some decision-making issues down the road. So we'll look at ABC in a different chapter and dive into that and when it might be appropriate to use it. The amount of overhead applied to all jobs during a period is going to differ from the actual amount of overhead costs incurred during the period. When a company applies less overhead to production than it actually incurs, it creates what's known as underapplied overhead. When it applies more overhead to production than it actually incurs, we call that overapplied overhead. We previously talked about MO as an account. MO is really a bucket where we accumulate costs. It behaves like an asset in terms of debits and credits. But remember, that mow bucket has to be completely emptied out before we get to our financial statements. We have to empty out the mow bucket. So to the extent that we have underapplied or overapplied overhead, we've got to clean up that bucket. We can't leave it there. We've got to fix it, which takes us to this concept. We're going to have to make adjustments for any under or overapplied overhead. So what's going to happen to it? The cost of goods sold report on a company's income statement must be adjusted to reflect under or overapplied overhead. The adjustment for underapplied overhead increases COGS and decreases net operating income, where the adjustment for overapplied overhead is going to decrease COGS and increase net operating income. That sounds good, but did you really grasp that? Could you make sense of it in the form of words? I think it would make some more sense to look at it in terms of T accounts and journal entries. Hold on 1 second. Okay, I've gone ahead and drawn up some basic T accounts for us. Of course, we see lots of letters and acronyms here. So here we have MO, manufacturing overhead, where we're going to accumulate all those indirect manufacturing costs that we incur during the year. And then remember, we're going to apply MO to each of our jobs. So we're going to have various different jobs, each with their own WIP, each with their own work in process account. We're going to touch more on this in chapter 3. I just want to introduce the idea so it doesn't sneak up on you next week as we study chapter 3. So we're going to be applying MO into the WIP for each of the jobs. Now, of course, when we finish those jobs, then they go to finished goods inventory. And then when we sell them, then it all gets expensed over to COGS, cost of goods sold. So I'm not going to do that entire process, but I kind of want to talk this through, what we mean by underapplied or overapplied overhead and what it's going to do to COGS on our income statement. So let's say during the year that we've been incurring all this MO. So we'd be debiting MO for all of those MO costs during the year. Let's say that it adds up to 1,000. And based on our predetermined overhead rate, we end up applying $800 of MO over to WIP for this particular job, our one and only job. I'm trying to keep things simple here, right? So if we're going to apply MO to WIP, that would be a debit to WIP, let's say 800, and a credit to MO. So it's moving from MO over to WIP. So we're debiting WIP, crediting MO. So what does that leave the balance as in our MO account? We've got 200 left there. Is that okay? No, remember that MO bucket has to be totally emptied out at the end of the year. So in this case, we have underapplied our overhead. So we're going to end up making an adjustment to clean that up. And that adjustment is going to involve a debit to COGS and a credit to MO so that we end up with 0. Remember, there can't be anything left in the MO bucket. So the underapplied MO ends up increasing our COGS and therefore decreasing our net operating income, right? It made our expenses go up to what they actually should be. We'll talk about different ways of handling this, but this is the basic way of dealing with it. Let me do another example using overapplied overhead. So again, let's say that we have MO that's accumulated in our MO bucket during the year of $1,000. But this time, based on our predetermined overhead rate and our cost driver, we end up applying $1,400 of manufacturing overhead to WIP for our one and only job for the year. So again, when we apply MO to WIP, that would be a debit to WIP of $1,400 and a credit to mow. So I'm going to credit mow $1,400. And of course, then we end up with a negative balance, a credit balance in mow. So we have over applied our mow by $400. Too much. We didn't even incur that much mow and we've applied that much into jobs. So we're over applied by $400. Well, how do we fix it? We have to make the mow bucket empty. So to make the mow bucket empty, we're going to have to put a debit of $400 into mow. Sorry, a little sloppy here. And that'll make it arrive at 0. So if we debit there, then we're going to be crediting COGS. So when we credit COGS, that's decreasing our expense, right? That's kind of weird to credit an expense account. So we're decreasing the expense COGS, which is going to be increasing our net operating income, essentially because we over-expensed our mow. We applied it to WIP. When we finish the job, it goes to finished goods. When we sell the job, then we expense all of it to COGS, but we overdid it by $400. So this is the adjustment to bring it back into check. I hope all these T accounts and debits and credits make sense to you. In Chapter 3, the focus will be much more aimed at T accounts, debits, credits, and journal entries for this whole job order costing. So we'll study that more then. I just wanted to introduce this concept to you because I didn't feel the way they presented it here really gave us enough info. It was just words on the screen, but it didn't mean anything. So hopefully this view tells you a little bit more about it. So if we take those job cost sheets and we add them all up, right? So we had done the wooden cargo crates on job A 143 and we came up with total cost of $268. Well, if the company adds up all of their job cost sheets, essentially that's their subsidiary ledger. The sum of all of that is what's going to add up to their COGS. So the job cost sheets provide an underlying set of financial records. It's the backup data that explain what specific jobs comprise the amounts reported in WIP and finished goods on the balance sheet. So if we had literal paper copies of these job cost sheets and we could have a stack of all the ones that weren't finished yet, the sum of all that should be what's in our WIP account. And then if we have another stack that, okay, these are all the jobs that we've finished but we haven't sold yet, meaning we haven't been paid for them yet, if we stack all those ones up that are finished goods, that should sum up to our finished goods on the balance sheet. And then if we take out the ones that we've actually sold where the customer has paid us, that would then add up to our cost of goods sold on the income statement. So these job cost sheets, whether they're actual paper or they're documents in a computerized system, are the underlying ledger that explains WIP, finished goods, and COGS. So a lot of this chapter was focused on manufacturing applications and making something physical. But like I said at the beginning, job order costing is also commonly used in service industries. So job order costing is commonly used in different types of companies like law firms, accounting firms, medical offices. I would even say personal services like hairstylists and, not that you're going to send them a bill, but you would accumulate your costs by job in terms of understanding your profit there. So any type of services where we're going to customize it to somebody's specifications. So certainly law firms, accounting firms, medical services. We don't just assume that every client or every patient is the same. They're all unique, so we charge them for what we're doing, and we want to have a good idea of overhead and how we would apply it. Most commonly in those situations, our cost driver is probably going to be labor hours, but I suppose it could be something else. but that would be most common. So do think of services when you think of job order costing as well. That is the end of chapter 2. Not too long for this chapter. We'll study more on job order costing in chapter 3, like I said, including journal entries, T accounts, debits, and credits. So if you need to blow the dust off of that section of your brain, go back and study up a little bit on some of the things you learned in financial accounting. So T accounts, debit, credits, and journal entries. Might want to brush up on that before we dive into chapter 3 next time. All right, talk to you soon.